Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go. It's generally related to three different topics: wealth building, commodities, and or financial topics. So let's dive in there. Let's take a look and see what's going on Twitter. If you want to follow me, it's at finding_finance. And if you want to join our community, it is finding-value.com, where I dive deeper into sectors, individual companies. You can see how I'm playing this commodity bull market, and you can see all of those moves on there. We still have a discount coupon code called Mayday, Mayday, which is one word. It is still active. You get 50% off the first month if you'd like to try it out. Or you can switch to the yearly membership and get a larger discount if you're interested. Coming on down to the business cycle. I said, where are we at in this business cycle? We've got the performance that underperformers at the top, outperformers at the bottom. So what are we seeing? How can we tie this together? We can use technical analysis to determine where we're at in the cycle. I've talked about, on the website with some of you guys about a stimulus overhang. Perhaps rates have gone up too fast. Maybe it will slow down the housing market where we get a bust cycle, much like 2000, 2001, which is the tech crash. I think something like that is very possible. There's a lot of things going on, a lot of moving pieces that have conflicting information going on simultaneously. Some of that information that's going on simultaneously is a lot of fiscal spending. So that fiscal spending is stimulative by nature with that money coming into the system. We can also see that there's a slowdown in manufacturing, and that's kind of going back and forth. We've got residential construction spending that's up. We've got employment from construction spending that hasn't rolled over yet. Doesn't mean it won't. We are underbuilt in the housing market. We have low inventory in that housing market. But affordability is absolutely trash because we've had the fastest rate hike cycle in history, which is causing havoc and slowing down home sales and both existing and new home sales. So we've got a lot of moving parts here. One thing that we can look at is what is outperforming what is looking like it could potentially bottom. Are interest rates going to move up or down? Those are all indications of where we're at in the business cycle. If I were to guess, we're in an expansion phase of real estate still. We could head lower, potentially. We've seen permits kind of dip. We're seeing housing starts dip to some extent. We haven't seen the unemployment go up in the construction area yet. It doesn't mean it can't. We've got commodities that are basing out that look like they've completed a first wave, and we're in basically close to the completion of a second wave, which is a pullback wave or a consolidation sideways. So energy's been consolidating sideways. They've dumped strategic petroleum reserve barrels on the market around the world, specifically the United States being one that has really dumped a lot on there. So there's been a lot of stuff that has gone on to either slow the move down or distort the market or try to do things where they manipulate the market, whether it's good for oil or bad for oil, or good for rates or bad for rates. There's manipulation going on all over the place. Fiscal spending kind of papering it all over, liquidity coming in and out of the markets, reverse repo. There's a lot of stuff going on all at once. If I were to look at the charting and I were to look at the sectors and look what's outperforming what at this time, I've seen a lot of technology stocks do well, but the breadth isn't there. We're starting to see the bond market, if rates were to drop, and that's a big if, but if they do, bonds could start to outperform, which means that we could roll into and go down here where bonds, stocks, and commodities all go kind of pour together, or we transition because bonds were underperforming. They are underperforming bonds, and stocks. We went through that underperforming here where they all go down together, but this has been muted because I think fiscal spending is kind of hiding some of this stuff. So stocks are consolidating sideways even though it's out of cycle. If we do see bonds go up and interest rates go down, we could enter stage one again, where this cycle repeats back around. This business cycle is driven by the real estate cycle and the hiring. So the employment and unemployment with regards to the real estate cycle is a big driver of that. We have an underbuilt scenario with real estate, and I'll show you some data on Twitter showing that, which makes it even more difficult because then it makes it a potential tech crash where tech rolls over eventually. It could bring everything down with it. They could lower interest rates. The lowering of interest rates is going to be very similar to 2001 and 2002. Commodities are going to rip for like 4, 5, 6 years. Home prices are going to rip because we see weakness in the economy. And I don't know how Powell can keep rates elevated if we see that weakness in the economy and the housing market. But if he lowers rates, I think demand for those homes is there, which will quickly push us back into an expansion phase of real estate, which pushes us back into the business cycle to the upside. And it would be almost identical to 2000, 2001. And that could be where we're at with the markets right now. It's very similar to 2000, 2001, where we get that pullback, the slowdown, and then they lower rates, the dollar declines, and we get a big commodity surge and an expansion phase of real estate. So I think that's my opinion of kind of where we're at and how it's playing out over time. And I'll show you more data as we go through it. So it says, interesting stat here, since 1980, the S&P 500 index never peaked in June. So we had a peak in January, a bunch of peaks in December, some in October, November, but not much from February all the way through about September. Not too many peaks for the market there since 1980. June never had any. 0 in April, 0 in February, 0. June S&P Global Manufacturing PMI up to 51.7, which is expanding versus 51, and 51.3 prior. Services are up 55.1 versus 54 estimate. Composite up 54.6 versus 53.5 estimate. Central banks were recently asked why they buy gold. The responses were not surprising but reassuring. Almost 50% of respondents cited for three main reasons: no default risk, strong performance during a crisis, and historical significance. In reality, no other asset matches gold's neutrality, resilience, and centuries-long role as a monetary alternative. It's remarkable that gold still has one of its lowest global allocations in history, especially during a time of significant debt and fiscal irresponsibility. Markets and asset allocations follow long-term cycles. And today's conditions present one of the best opportunities to invest in metals that I've ever seen. So central bank gold reserves survey, what factors influence your decision to hold gold? And those are the three: no default risk, performance during times of crisis, and historical position. Rolling on back to the stock market is in a bubble of all bubbles, which will lead to an epic stock market crash next year and potentially usher in a depression, warns economist Harry Dent. How many times has this guy predicted a potential bust? I would say it's been absolutely every single year since like 2011, maybe. So he's had a bust. I saw Harry Dent here, and I gotta repost this. This guy's been wrong the most I've ever seen of any person that makes market predictions. He's been wrong. So you can't really bet against him because At some point, he will be right, but he's called a bubble, I think, every year since 2011, or maybe it's been since 2008. I don't know. And then ever since they did the stimulus. So Patrick Karam says historical, very big picture chart. Once again, 125-year inclining resistance trend line, longest I've ever seen, is getting tested. However, notice the dwindling momentum, and he's talking about this momentum down here that's basically broken down from its increasing trend since 2000. Actually, that goes all the way back to the mid 2000s, and that's broken here recently to the downside. So we could see a downward move in the Dow Jones Industrial Average, or a sideways action move, much like 28, 65, 99, and 2021, which is the beginning of commodity bull markets in every single case. The beginning of commodity bull markets in every single case. So that's what we see. We see the Dow Jones go sideways or slightly lower for a period of time, and that is when commodities like to rip it. Are we going to get a slowdown first? We very well could. We could, where everything goes down, gets pulled back, and then commodities rip when they lower interest rates and inflation starts to rage again, due to the underbuilt scenario in housing. And we'll go over that here at some point. Not the time to get bearish here. This is for Bitcoin. And I just like the lead-in pattern that they've got. That is that lead-in pattern that I look for. Now the pattern looks a little bit different than these. You get a big surge up, you get a pullback on smaller volume, and then it kind of goes to a dead period before a run. Big pullbacks, small pullback on small volume, and then a big run. Is that the same pattern here that we're seeing as before? Maybe, maybe not. Tough to say. And again, if I don't think this will manifest itself if we get a slowdown in the market and NASDAQ were to go down. I just don't think so. This is more or less a juiced NASDAQ. This is what I was talking about, the housing market being underbuilt. It says the U.S. housing market is 1.5 million homes short of a balanced market. U.S. housing market is 1.5 million below a balanced market, says Freddie Mac. To bring the vacancy rate, both rental and homeowner, back in line with historical averages, the U.S. would need to add an additional 1.5 million vacant, for sale, and for rent homes. They said vacant. So if we are at a deficit of 1.5 million, that means we have to build 3 million to get back up to 2008 type levels of where we were before. 3 million is a lot of home building. So there's a lot of building that needs to get done for us to get this into a balanced market and then eventually into an oversupplied market. And then you'd have to build 3 million homes to get back to 2008, 2009 levels where we were in a wash of supply. I don't think that's going to occur anytime soon. And this here, if they were to lower interest rates, I think home prices would go up because of this imbalance here, the housing market balance of being down 1.5 million units. This here is commodity juice, is what I'll call it. It's credit expansion, and commodities will go up in that type of building environment. Liz Ann, so this is also talking about the housing market. It says both housing starts blue and building permits orange are now back in downtrends, with formers level now at nearly 4-year lows. So we have been pulling back in permits and housing starts, although we've got a 1.5 million home deficit. And that is where I think if they were to lower rates, this will go back up. So the rates and the affordability are definitely impacting the number of units and the sales because it's limiting who can afford what. It won't. You can keep these rates high. It just slows the market down. It won't crash the market because we don't have the supply to crash it with. There can be areas where they've overbuilt in terms of specific cities that can go down in price. Austin, Texas being one of them. But overall, for the whole entire country, we're underbuilt, and that will be support for higher prices or prices that remain at least resilient. When to sell and take your profits from William O'Neill. Let's take a quick look. I know a lot of people ask me, well, when is it time to sell? It says you, as the merchant, must sell your stock if you're to realize a profit. And the best way to sell a stock is when it's on the way up, while it's still advancing and looking strong to everyone else. This way, you won't get caught in the heart-trending 20 to 40% corrections that can hit market leaders and put downside pressure on your portfolio. You'll never sell at the exact top, so don't kick yourself if a stock goes still higher after you sell. What I found is I earn more when it actually turns over, rolls over, and I sell, and all of the indicators that I watch are screaming to sell. So that's when I'm going to sell. I'm going to sell when the indicators are screaming to sell. And maybe that's before the absolute market top. Maybe that's slightly after the market top. But as long as I capture the majority of the gain, that's what I'm in it for, to capture the majority of the gain. So coming on to, looks like I hit the wrong button there. Coming on down to Jesse Felder. It says, when you get these periods where commodity prices or real assets in general become super dislocated relative to financial assets, what you often get is a change in the global monetary system. Are we getting a change in the global monetary system because of this super dislocation? It has in the past, so we could. Definitely possible. I said, I wonder if this has anything to do with Warren loading up on the boat. So I'm going to go back here. It says Warren Buffett's Berkshire Hathaway has scooped up more shares of Occidental Petroleum over each of the past 9 trading sessions, driving his gigantic stake in the Houston-based oil and gas producer to almost 29%, according to the regulatory filings. And this was posted a while back, and I know Warren was talking about this, and this is also one of the reasons I'm in energy myself. What Vicky says, she's the CEO of Oxy, she says the oil market will face supply shortages by the end of 2025. Occidental CEO says the oil market will face a supply shortage by the end of 2025 because the world is not replacing crude reserves fast enough. She says about 97% of the oil produced today was discovered in the 20th century, she told CNBC. And Warren's out there just buying the crap out of this. I hold a lot of oil because of this reason. I think there's going to be a supply shortage, and that's going to impact the world in ways that are similar to the 1970s and 1999. The real estate market was a big driver of that, but those occurred with credit expansion in a world where we could grow oil production. So it was a mismatch between world oil production and credit expansion. What I think is coming, or what could potentially come, is fiscal debt expansion when we can't grow oil. And if that does occur, I think 2 asset classes will outperform absolutely everything. I think oil being the most sensitive to inflation, and also the pacer or the leader of GDP. So it paces how much GDP you can have. And if we get a supply shortage of oil, I think it will cause absolute havoc in world economies. It's going to be very inflationary. Oil is going to moon, and it's going to put intense pressure on currencies. And what we saw is going to be something similar to the 1970s, but on steroids if those same market conditions occur, which is a shortage of oil. The shortage of oil was only contained to America. And then people became worried about the bond market, the currency market, and precious metals went up immensely during the 70s. I think the exact same scenario is coming ahead of us, where oil could get short on a worldwide basis, where we squeeze oil to some degree, and then we get the entire world worrying about bond markets and currencies all at the same exact time, leading to what could be one of the largest bull markets in precious metals that we've ever seen in the history of mankind. So the demographics of the world are driving it. It's the demand of energy. Energy will be one of the best investments just in general, all energy and anything that deals with energy, transporting it and stuff like that. And then if we do get a dislocation in supply, which I think is highly possible, we are going to see oil rip it and probably the bond market, currencies, and interest rates go way up with it, and then a potential scare into precious metals. Nick, sleep on your holding your winners. So the biggest mistake an investor can make is the sale of a Walmart or a Microsoft in the early stages of the company's growth. Mathematically, this error is far greater than the equivalent sum invested in a firm that goes bankrupt. So let's dive in a little bit. It says the biggest error an investor can make is the sale of a really strong company early in its growth phase, like Walmart or Microsoft, in those early stages of the company's growth. Mathematically, this error is far greater than the equivalent sum invested in a firm that goes bankrupt. The industry tends to gloss over this fact, perhaps because opportunity costs go unrecorded in performance records. The reason I'm talking about this is because you got to let your runners run. You got to let your runners run. You want to pile into your winners and you want to cut your losers. That is so important because the symmetry that you lose when you don't let your runners run is a bigger mistake than bombing out on your losers. So I've talked about this on the website some about how I set up the portfolio. I gave you guys examples of last bull market and the returns and why you can have some of the companies bomb out and still beat other strategies. This is exactly ties in with that. You got to let your big runners run. And the symmetry is going to carry the portfolio higher. But if you cut your symmetry, you never allow your portfolio to run. It says housing has not weakened at any point consequently. This is the main reason the recession calls from both the market and the Fed have been so wildly wrong and I'd argued baseless. That's because the strength in the real estate market. It says the Fed keeps easing FCI to mitigate risks that don't even exist and just push housing prices to the roof. And he's talking about the house prices that have gone up continually. I'm having problems with my clicker here, guys, so be patient here. He's talking about this here. Median sales price is up 4% year over year, still over last year. The median asking price is up 6.6% year over year. We've got U.S. homeowner vacancy rates down at all-time crisis low levels compared to history, which that is the tell-all of a housing shortage. Your vacancy rates are low, much like the 50s and early 70s and the 70, late 70, 80 there. We've got very low housing market inventory. And then home price to income ratio is way up there. The reason it's up there is because of the shortage, and we have to price out everybody and their mom to get this housing market to balance each other. But the affordability is obviously having an impact on sales volumes. Because in order to build all these homes to get the volumes up, you need affordability to be there to sell to a larger group of people. Tech capex versus commodity capex. So there's only so long that tech can expand without commodity producers digging up the stuff they need to make things or the energy to power them. The blue is the commodity sectors. We're real low here, bottoming in 21, 22 there. We've got a long way to run higher, but tech, everyone's piling into tech, and this big divergence between tech spending and commodities is going to reverse. It's going to go, it's basically the same as 2000, 2001. Remember I was talking about 2000, 2001 and a tech bubble? It's the same thing. It's the same setup. We're in the same situation as 2000 roughly, where commodities were underinvested and tech is overinvested. We got the same situation. These jaws will close and it will go probably to extreme levels in the opposite direction eventually. The new world class tier 1 copper discoveries are becoming very scarce. It's harder and harder to find new significant copper deposits, even with higher exploration expenditures. Just look at the stunning downtrend in global copper discoveries below. You know what else has the same look? Oil discoveries. Oil discoveries are absolutely pathetic. They have like nothing for a very long period of time. It's even worse than this copper chart. So all of this is going to manifest itself sometime in the near future. The exact timing is unknown. And the question is, how do you position for that when it does come? And what does it look like? Could it cause a recession where we go through multiple contractions, expansion, contraction, expansion, contraction, where we basically flutter along super high oil prices and they crash when they get too high, and then they go up and crash again, and it just goes and cycles back and forth. That's what a lot of people are predicting that have looked at this with some sort of thought. But we're seeing this across a whole bunch of different commodities. We just don't have it. So are we coming towards the end of some of these resources and the flow rates that we can attain in those resources? Also, if ore grades continue to decline in a lot of different commodities, your input of energy needs to go up exponentially to increase the flow rates of those commodities. So it's not just that we need to mine more copper or wherever it is. The ore grades are declining, logarithmically towards zero, and we need to exponentially increase our energy inputs. That is going to be a game changer that people I don't think are thinking about in terms of energy demand. Brian Feroldi says from 1980 to 2014, a JP Morgan study found 40% of stocks lose money, 64% of stocks underperform, and only 7% of stocks accounted for nearly all of the gains. One reason indexing investing works so well is all of the chaos is invisible. Now, to get in the 7%, it's not too hard. You can just look around you and see what's growing around you and invest in those companies, and you'll capture most likely the majority of the 7% stocks. If you're going into regular companies. So regular companies that I can just look at growing throughout, the 90s, the 2000s, Nike, McDonald's, Coca-Cola, because you have Sprite. These are things that I used when I was growing up. US Bank, Fidelity. We can look at Visa, MasterCard. You can just look around and see what everyone's using, invest in it, and more than likely you'll make a bunch of money. There's insurance companies too, like Blue Cross Blue Shield's been pretty big. And you just invest in them and you basically are in one of those 7% stocks. That's it. Frac crews, with the current level of oil rig drilling and well completion fracs, it will be very difficult to see any oil production growth in the U.S. And I'm just tying that back to what Vicky said too. And we're coming back down in frac spreads and all sorts of stuff. Rig counts down. I just don't see it increasing dramatically, oil production anytime soon. It says, regardless of the quality of the business, no business should be purchased above its intrinsic value. Buying a business above its intrinsic value is not investing, it's gambling. Totally agree. A lot of people do that. They just chase price. Another one, if you can't find any companies that you think are attractive, put your money in the bank. If there's nothing smart to do, cash is the default option, says Peter Lynch and Warren Buffett. Another one from Peter Lynch says, your ultimate success or failure will depend on your ability to ignore the worries of the world long enough to allow your investments to succeed. And I'm going to leave you on that. So that's what I've got for today, guys. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you'd like to. And that's all I've got for today. So we'll catch you next time. This is Finding Value.